Hello, I'm Jason Furman, a professor here at the Harvard Kennedy School and jointly in the economics department at the Faculty of Arts and Sciences. And really excited that the Mustapha Rahmani Center for Business and Government is discussion today with Andrea Orcel. He is the CEO of UniCredit Group since 2021, has worked in a dizzying array of roles across a spectrum of banking issues at Bank of America and UBS, among many others. Larry Summers has called him the Vince Lombardi of banking. And the bank that he is in charge of now is Italy's only systemically important bank and the world's 34th largest bank and one of the most pan-European banks in Europe. So I'm really excited you're here and excited for our conversation. So my plan is to start with a set of broader questions that aren't about the current moment, then get a little bit more into the current moment, then talk about the future. If we run out of things to talk about, I'll ask you your macroeconomic forecasts, and then we'll go to all of you for your questions. So the one I wanted to start with is something I've been asked a dozen times and I've never had a good answer to. So I'm hoping you can help, which is in the United States, we have a financial system that's quite diverse in terms of relying on bank loans, but also having access to capital markets for financing. European companies are much more dependent on bank loans with a much less rich capital market. Why do you think that is? Do you think it's a problem? Do you think there's something Europe can do about that?
Well, like many other things in Europe, I think it's not a decision; it's an absence of decision. So to have a well-developed capital market, you need to do some structural reforms, which Europe is not ready to do or has not been ready to do. Same thing for banking union. To have unified banking system, you need to put together a foundation and do that. Europe has not wanted to do that in the past. So as a result of that, we have a double problem from a financial standpoint. Number one, we do not have the developed capital markets that are propelling the US and are allowing also banks to recycle a lot of the debt that they, or a lot of the loans that they do. And number two, therefore, we are more reliant on banks than in the US. And number two, the regulation is more, it's stricter. So it prevents banks from being able to, let's say, expand or to support to the level that they now would be required to do because the capital markets are not working to the level that they should. So the two things combined means that there is a structural, let's call it imbalance or a negative imbalance, where if you're looking at Europe and you're looking at the financial means to propel any economic growth or structural growth on certain sector of the economy, et cetera, there is not enough thrust as you would have here. And this is obviously constraining growth.
You say heavier regulated. Is that each of them nationally heavily regulated or the difficulties of operating across Europe?
I think,
and the different regulations. Yeah.
First of all, I mean, you see that if you read anywhere, but Europe stopped before banking union. And what does that mean? Yes, we have a, let's say, an oversight that is pan-European, but it's still quite dependent from the single country regulators. And the two need to coordinate with each other in order to manage banks. And then there are a lot of, let's say, exceptions and restriction in the application of the pan-European regulation. So, for example, at UniCredit, we are 13 banks in 13 countries. In every country, we have a legal entity. In every country, we have a board. We have a management committee. We have separate technology, separate this and separate that. Certain countries allow us to move freely liquidity within our group. Certain countries do not allow us to do that. So, for example, I was giving this example this morning. We had a few years ago an instance where required an injection of liquidity which the group was very happy to do because the group was long liquidity and Germany was short liquidity. We provided the liquidity to Germany, and after we provided it, then Germany went out of the situation where it needed this added liquidity, and obviously group wanted the liquidity back. You can't get it back because Germany does not allow you to move liquidity outside of the perimeter of the country. So once it goes in, it's not coming out. That affects your entire liquidity management. It affects how you are managing the bank. It affects a lot of things. And so I do think we have a lot of these exceptions to the rule, and it's a lot easier. So if I take, let's take one by accident. If I take JP Morgan in Europe, JP Morgan will be able to set itself with a main legal entity in one of the markets and then branch out in the whole of Europe. They can. I cannot. And I cannot because we are the result of 13 banks, and those banks are very important for those countries. And I cannot start branchify, and therefore I have a complexity level that a new entrant or a foreign entrant does not have. So I do think that these things are preventing a free flow of capital and liquidity between the various markets. They are creating a lot of inefficiency and price differentials between the various markets. And we discussed that a bit last night on cross-border M&A. We are a pan-European group, so we deal with that. But if we had to start today, it's difficult for us to justify where we are, because when you buy beyond your borders, the level of synergies and the level of value add that you can create vis-a-vis an in-market integration is night and day. You can't really justify to investors.
Right. And that you have helped me explain something I've wondered, which is I wander around Europe and see Citibank ATMs in every country. And then I see the national ATMs, and I don't see a whole lot of retail banking across Europe. And you're saying it's much harder for a European bank to do that.
Well, it is harder because for example, if I were to open organically, so from zero, a bank in another European country, that's not that difficult. But if I want to, as I do, manage a bank I have in Austria or in Italy or in Germany that is number 2 or number 3, so very significant for the country, in a way, let's say, as one group, as opposed to a legal entity for that country, that I cannot do.
Can you give me the best argument for the stupidity that you don't like? Well, what an articulate defender say.
I do think it is, when we look at Europe, we all talk about Europe, but Europe is a conglomerate of many countries with different culture, different history, different everything. And I do think that we've done the first part of our coming together. I mean, Treaty of Rome till the early 80s, and then we stopped. And then we stopped because the next level of integration collided with, yes, but I'm different. And yes, we are different, but that does not mean we can't put common building blocks together and create value for everybody. And I think we missed the fact, and we were discussing that before, that for me, the tragic thing is that if you take the US and Europe 15 years ago, they practically had the same GDP. And if you look at US and Europe today, Europe is about 15 trillion, and the US is about 27. And Europe has about 100 than the US has, which means on a GDP per capita, it translates into Italy having the GDP per capita of Mississippi. And it shouldn't. But these constraints, we are so focused on, I'm not going to do that because my taxpayer cannot underwrite your risk, or this other one because my country needs to have the largest bank in the country, or the largest this or the largest that. All of these things translate into a absolutely astronomical destruction of value, progress, job opportunities and everything else. And we have a tendency of never looking at that. We look at why we shouldn't get together. So I hope that Europe does. The potential is there. It's one of these things, but you need to crystallize that potential.
Right. I mean, in the United States, if every one of our 50 states needed to have a national champion bank and an airline and a national in every dimension, that would be incredibly inefficient. I think that rationale makes no sense. There's another rationale, though, which is the famous saying that banks are international in life, but national in death. And that if anything goes wrong, Germany's going to have to deal with the German bank. Italy's going to have to deal with the Italian bank. Spain's going to have to deal with the Spanish bank. And so it's hard to tell those countries, don't pay attention to this problem that will, I'm sorry, not this problem, this potential problem that will ultimately be yours. No, what's the solution?
So I do think that's absolutely correct, but I do think there are a few things to consider. First thing is, if that is the issue, let's resolve that issue. Because if you told banks, for example, okay, we can have a banking union, but we need to resolve that issue. And that requires you, for example, to have certain levels of capitalization, certain level of liquidity, certain levels of holding of sovereign debt, the local sovereign debt, which is a hot issue for us. I think banks would sign on the dotted line for that. So instead of saying we're not doing it because we're not ready to do all of these things, why don't we look at these things and say, if we do that, would we go for banking union? Because I think you would find buy off by most of the banking system on that. The second thing is, if you look at the European banking system today, vis-a-vis what it was 10, 15 years ago, it's night and day. I mean, if you look at the level of capitalization, the level of the asset quality, the level of liquidity, and all of the above, the probability that one of these banks or one significant bank goes under is dramatically lower than it was 15 years ago. And quite surprisingly, if you look at some of the strongest banks, they are in the countries where, in theory, people are worried about having to bear the burden. Because if we take Italy for one, and I come from there, and you look at what are some of the better valued banks in Europe, the most capitalized, et cetera, they're Italian, they're actually not German. And that does not mean the German banks are bad. It just means that on a relative base, there has been a lot of catching up in these countries. But I do realize that if you want to look at it structurally, first thing, deposit guarantee fund. Is that national or is that European? That's the first issue. The issue being, you're taking deposit from my population, are you using it somewhere else? And if you go under, who is repaying my deposit? And I do think it should be European, but you should put a lot of thresholds in terms of the strength of the organization and what you do with those deposits. A lot of those exist already. Second one is how much of your sovereign debt do you hold? Because in Europe, if you hold in Europe everywhere, if you hold your sovereign debt, the risk weighting is 0, so it's very advantageous to do it. So the argument goes, oh, but Italy is very highly indebted, so is Greece, so is Spain. And if I am in Germany, you're holding debt of your sovereign, that's a level of risk. If your sovereign doesn't repay, who foots the bill? Okay, beside the fact that we could limit easily that, but the other issue is, let's see what we're saying in substance. If Italy as a country does not fulfill obligation on its sovereign debt, I mean, we're going to have massive issues in Europe, full stop, given the level of integration that we have. But massive, because it would mean that the entire country economy implications for if there was a debt, some event like that, it would be much greater. I would also like to point out that probably the biggest holder of Italian debt are not the Italian banks, is the ECB anyway. So the taxpayer of Europe is already exposed to that. So the issue is, again, let's make sure this does not happen. What are the boundaries, etc. But we use all these things to prevent the integration that allows us to lower the cost of debt, to lower the cost of capital, to propel the industry in all of the countries, that equates to lower GDP growth, to lower progress, etc. It's trying to protect against. We're getting back in spades more negatively through what is the impact on the economy.
Yep. I mostly want to talk about banking, but since we've been talking about European integration, I'm wondering, is there any other place, or not any other place, if you have any views as to other priorities, digital or European-wide or Euro area-wide finance minister, where else is the integration incomplete?
Well, I think if you take Europe, start with defense. I mean, if you look at Europe as it is today, it would make sense to have a pan-European defense and not a single country defense. It doesn't make any. I mean, no country can afford the defense budget that Europe as a whole can do. And a lot of the debates we're having, or we're having today on the war in Ukraine would be different if Europe had a full-fledged army and everything else, which no country can afford, but all together would. There is a lot of, in every sector, you started this conversation saying one national airline, one national telecom company, one national bank, one national. So if you do that 35 times, you are going to be, by definition, very fragmented. If you have convergence, the benefits to everybody would be much higher. So I do think it's, and I use this as maybe as a parallel. UniCredit had the, let's say, challenging legacy of having grown when the European dream was still very tangible, and we are present in 13 countries. No other bank in Europe can say that we are where we are. Italy only weighs 40 to 45% of the total. Everything else is abroad. We're third bank in Germany, first bank in Austria, and we go and we dominate the Balkans, etc. So if you look at that, when I arrived, it was like I had a list from there to there on why being one group would never work. In Croatia, it was different from Serbia, which was different from Bulgaria, from Italy, from Germany. I had more than 20 IT platforms. Every country wanted their servers in their own country. No cloud strategy, and I can continue. Everything, but it's not only that. It's a mortgage in Austria is different from a mortgage in Italy, which is different from a mortgage in Germany. And yes, of course, there are differences. But the point is, if you focus on them, you are not reaping any synergies from it. So just by saying, fine, we're going to re-empower our several countries. And that's fine because you know better about your population, your business, your clients, and everything else. But we have one vision, one strategy, one plan, one direction of travel, and we're going to put to common denominator all the things where there is a scale and a scope effect to the benefits of all. So procurement, why do I need to have 30 contracts with Microsoft? I need to have one. Or technology, I can't have a fully integrated technology 100% because I will never be able to. But I can today, with the technology that exists today, I can have it 80% common. So if I can put my technology 80% common on 15 million clients, where the largest country, Italy, has 7 million, I will have a scale effect that is a lot greater than if I fragment it several times. So we put that in common, or we are putting that in common. What we call factories, which is common. So payment systems, insurance products, asset management products, advisory, capital markets, trade finance, hedges of various sort with markets, businesses. All of that makes no sense to have it fragmented, so it's at the center. So yes, you own your client, you take the decision on your clients, you pass the empowerment back, and in that, I respect all your diversity. But all the things that I can put to common denominator that are undifferentiated, why on earth can't I do that? I think Europe needs to find that balance somewhere, and to find the balance between what you give and what you keep, and we haven't managed to do that yet.
Great. And the record will show I asked you about non-banking integration issues. You started with defense, and then you went right back to your passion.
Yeah, I know.
Hearing you go on about it, I'm now almost as worked up as you are. It seems crazy. Now I want to talk about another international issue, which is outside the European Union, where the issues aren't that you're facing different regulations, different procurement, but geopolitical issues, and try to understand how you manage that risk just as a bank and a business person, and what role you think your company as a European company should have more broadly than just doing business around the world. Why don't we start with Russia?
So I think that if you had asked that question 5 years ago, but no, even less, three and a half, the appreciation of geopolitical risk was probably on the low end, right? So
before you were CEO.
Well, but in general, because while there was unrest or issues, but generally there was a view the world is global. We optimize value chain, we optimize where we are, and yes, this country has issues and challenges that this other country does not have, but we're managing those. Right? With the invasion in Ukraine, that changed everything, I think, because it was the first thing, and I don't know how you see it in the US, but for Europe, we're fracturing away a part of Europe, which for the right reason, but we are fracturing it out. So Europe was fully integrated with us parts of Europe. If you take Germany, most of the raw materials and most of the raw material and energy was coming from there. All of a sudden, not over time, but over a very short period of time, you need to completely reset that. And that is massive. I mean, you look at the value chains of all the German corporates and also other Europeans, but Germany in particular, massive. And that's the first point. So now when I look at my value chain or when I look at my operations in other countries, I have to overlay what is the geopolitical risk. I have to. It is a decision you start from. So UniCredit was predicated on going from Italy east. Clearly, that's done. So where do we go now is very much linked to where is Europe going? So, for example, one could say, oh, well, Europe is importing a lot and doing a lot of business with North Africa. Well, are you going to go into North Africa? Well, but because it depends how closely integrated those countries are going to be and whether I anticipate that there can be a breakage. In banks, that is particularly sensitive because if I am producing, smartphones and I have a geopolitical eruption of some sort, I just stop shipping them. If I'm a bank on the ground, I have 20 years loans in mortgages. I have a lot of credit and deposit obligations over time. I can't just sell it, but when you got hit, nobody's going to buy it. So then you say, well, why don't you liquidate it? And have you ever seen a solvent wind down of a bank happen anywhere? No. So the point for a bank is when we go in one place, we better make the decision right because to pull back is a nightmare. Unless you have a branch or just are doing some corporate lending, cross-border, then that's easy. But if you go local, then pulling back is very difficult. And if you look at Russia, Citi has the same problem as we do. They have long-tail business, and the pullback will take time unless we find other ways to exit. So the answer is yes, geopolitical risk now is top of the agenda. So when we look at, especially we are in markets that are, let's say, more, I would call them gross economies, but not fully converging to the European Union. And then therefore, from time to time, you ask yourself, what risk am I taking by being there? Because if the political environment changes, then I'm stuck. But also if you look at the press, Turkey, we used to be in Turkey. We got out of that. We had sold before I arrived. But today, Turkey is very close to the EU, but there are all these articles and concepts that they are intermediating goods of various sort between the West and Russia. If we had a bank there, that would be a big issue for us. And so I think now the bank will go where Europe is comfortable of going, and it's not just, oh, I'm importing from that country, so it's okay. Be beyond that, where you feel that the level of the political relation and the level of integration between the economies of that bloc and Europe needs to be close, because otherwise for us it doesn't make any sense.
And for you, when you're thinking about something like Russia, how much of it is pure profit calculation because Russia's unpredictable and might do something, a pure profit calculation because Europe might force you to do something, or your view about some role you play above and beyond shareholder value?
So I think let's start from one thing, because this is a difficult decision that we had to take day one post-invasion, which was forget the lending that we have cross-border that we practically have run down to zero and exited. It was, we have a bank on the ground, and maybe the simplest way of looking at it, we have 2.5 billion euros, almost $3 billion. Let's look at it like that. There. Okay. So let's suppose I go to the extreme. I write it off. I close it off. I leave. I write it. I'm gone. And I renounce to all my ownership to that. Forget UniCredit for 1 second. I have just gifted 2.5 billion of value to a regime that I'm fighting against. And that is not what I'm supposed to be doing. Or let's suppose I take a number of actions that are illegal locally. That gives legal grounds. And that is a very important point, to intervene and take ownership. Okay, so I behaved illegally. That's why they took ownership. Regardless of the regime, I will never have a call back. I have again gifted 2.5 billion to a regime. So when we look at our ways of going out, I mean, frankly, if tomorrow I were to tell the market, we resolved Russia and we lost X, which for us is, just to put it in context, 25 basis points of capital. Practically nil for me. Everybody would be extremely happy. But I don't think that morally it is the right thing to do. So what we're doing is we're managing the situation. We've decreased our level of activity by about 70% in 2 years. Our lending is very low. We cannot control the deposits because obviously we're a bank. And it does seem that numbers of families in Russia see us as a safe haven. So we're taking deposit locally, which is not a positive thing, because while we don't pay for them, they have a cost to us, which is high. But this gives you an idea on how do you manage that from the standpoint of Russia. Then there is a second order of moral topic, which is we have, and still have, now a few less, but about 4,000 people on the ground. These 4,000 people have been with UniCredit 20, 25 years. Have families, etc. And from what I know, because we witness it day to day, I doubt they are in support of a war. Okay, you flip the switch, and what are you going to do now? So, because you're affecting 4,000 of your employees, which have the issue of being in a country that is behaving the way it's behaving. But I've learned that, discriminating against 150 million people because of a portion of those is not necessarily the right thing to do. So it brings that kind of issue. So I do think it's massively complicated. I don't think, I am certain that we're making a lot of mistakes, but we're trying to navigate this. And it is a minefield, because one thing that maybe people don't appreciate is, I think if you look at the sanction that the world has on Cuba, they don't reach 200. You know how many sanctions there are on Russia? 15,000. And they're not the same. They all have the same aim. They all have the same aim. They're not the same. And legally, it makes a big difference if they're not the same, because if Canada or Australia or the UK or the European Union have a sanction directed to the same topic, but it's written differently, and I don't fulfill by the dot what the sanction says, I have liabilities of multiple billions. So managing that is almost impossible. And that creates even the other option, which is operate by shrink, extremely difficult to manage because you need to go through that. I think going back to geopolitical risk, big lesson learned on how difficult that can be if you get the wrong decision.
And so you have time to apply that lesson to China, Taiwan. What are you doing?
Well, for us, that was easy, I would say, because the vision for our bank is to be the bank for Europe, and we realize where we add value and where we don't. We don't add value in China. We don't add value in the US because we don't have the capability to compete with US institutions here or with Chinese there. So if I have a Italian company exporting to China or a German company exporting to China, the rule was, oh, but I will accompany you in China. But if it's an important company, they will find much better term, much better service by a Chinese bank than they will find of us. We're not able to compete. So we had a presence in China. You're saying low 100 of people. Shanghai, we shut down. Hong Kong, we shut down. India, we shut down. We are in Singapore because it's important for us to have an observation point in Asia. But really, given the core of who we are and what we want to achieve, it was an easy decision. If you are a large company in Germany, that is not an easy decision. But certainly, we discussed it last night. It's if you look at it from a Europe standpoint, let's call it the Russia part of the equation is raw materials and energy. The China part of the equation is export. And if you look at Germany in particular, but also you go beyond and you look at Italy and you look at France, getting curtailed in both means a complete change in the way you look at your business model. Complete.
Great. Let's now talk about 2023. And if you know anything about 2024, you can tell us about that too. First, just the United States. When you looked at what you're in March, what were you thinking about how our banks were running themselves, our supervisors? What do you think went wrong?
Well, I think maybe two things, and it's Nonbanking kind of thing.
Which is not something Vince Lombardi did. He did it.
No, he did it at the time. No, but I do think two things maybe went wrong. The first thing is that you had a significantly differentiated level of regulation for banks of a certain size versus banks of the other side. That was predicated on regulation is, let's say, very demanding, costly, tends to, insert a lot of rigidity. So if you're a large bank, number one, you have to because you are systemically important. Number two, you can deal with it. If you're a smaller bank, less impactful, and you cannot deal with it. So those organizations that got hit had a level of regulation that was purposely lower. The second thing is just good management. To think when you focus a lot on regulation, you tend to forget that, I can put 10,000 roles of regulation. If you have a bad management team, you're going to have the issues anyway. And I think, I don't know how many of you are business degrees or whatever, but I think that the duration mismatch that some institutions were running was, I don't know, regulation or not, nobody would run that duration mismatch. And if you look at what happened is, for example, the first one, you had an extreme concentration of business model. So you focus on venture capital.
You're talking about Silicon Valley Bank.
Yeah. Okay. Venture capital, one geographic area. And from there, you lent and you took their deposit. Average deposit size 250K. And now all of a sudden, there is a trust issue on the organization and banks don't fail because of capital. Banks fail because of liquidity. Liquidity moves out very, very quickly. You need to sell the long-dated security you bought in your duration mismatch. Okay, so if you look that, and in the case, for example, if you take UniCredit, and not necessarily because we're better, but just because it's a very different business model. So number one, the regulation level, we couldn't have never run that mismatch anyway, even if we wanted to. But average deposit, $5,000. Fragmented on 13.
Can you remind us what the deposit insurance is in Europe?
100K usually. Okay. So $5,000, they fragmented in 13 geographies, very different segment of population, not a single sector. The read across is dramatically different. In addition to that, because of regulation and because of what happened to us in the past, loan to deposit ratio, 85%. So we have a level of liquidity and that is not comparable at all. So that does not mean that it doesn't give us reflection, because there is read across. So as you know, banks have what they call replication portfolio, which is a nice way of saying you take your sticky deposits, which are most retail, the one that don't move. There are various models to do that. You take a portion of those and you reinvest them in securities to create spread, right? So we replicate, well, if you look at all the deposit base, we replicate only retail with low balances, and then we take a haircut. When you replicate, we had an average duration of, in our case, 4.5 years. But if you think about that, look at the shock. We like all the banks, were in negative interest rate environment. Our replicating portfolio was yielding 70 basis points, which at the time looked like a great idea, -50 plus 70. Not a bad idea, especially when you cannot charge negative rates to your depositors, because people forget about that. So we were either -50 running or +70. A lot of banks went with a +70. Now rates in a very short period of time go from -50 to 4. Obviously, you're carrying a market loss in that replication port. So you can look at it two ways. Either it's back-to-back with deposits that are yielding 0. Therefore, you have an opportunity cost, but it is what it is, and over time you purge it. Or you have a massive mark-to-market loss on your replication, which over time goes to 0. Then the question becomes very theoretical, unless you have a run on the bank. So if people start grabbing your deposit and you need to drop your replicating portfolio, that's where you go down, which is why we have a lot of limits to that, and which is why when you have a low loan to deposit ratio, for example, I can afford to lose tens of billions of deposit without moving, because in any case, my loans are only now 90% of my deposits. So I have a lot of liquidity to play with. But if you're stretched and your loan to deposit ratio is at 120, it's completely different. So there are a lot of factors that play into this. And it's a lot easier that a person who has 250K with you withdraws the deposit than one that has 5. 5, what, for 1% or 2%, I'm going to move it. It's practically nothing. So they're not going to move it, but 250, they are. So I do think all of these considerations come into how you manage it. And this is, you may say, well, but it would be better if you didn't do a replicating portfolio at all, or if you didn't do transformation of maturity at all. But then what's the job of a bank? Because we tend to think banks have to take risk intelligently, manage it, whatever, and not take extreme. And, the acid test is always, if everything goes wrong, then you take the loss. But let's suppose I lose 2 billion. It's a lot. I don't want to lose them. Can I take the loss? I can. 5. Can I take the loss? I can. 25. Can I take the loss? I can't. So if you are in a number of situations where you have that kind of loss, you shouldn't be there. Because even if it is a 2% probability, it goes in that direction. And it's more likely to go if you are very vulnerable to some things. So I do think all of that yields to what? That Europe has Very different set of regulation because it didn't differentiate as much between up and down. There is some, but not as much. Secondly, the structure of our deposit franchise and loan to deposit, especially because we didn't grow for 15 years, is a lot less stretched than in the US. But also, to be fair, if you take the larger banks, you take JP Morgan, you take Bank of America, they don't have these kind of problems. They don't. We're generalizing to everybody, but actually they don't. So I do think it was lower level of regulation combined with management team that pushed the envelope too far. The two things were the problem.
Right. And so that last point was heterogeneity. So I'm glad you're not worried about JP Morgan, and they're probably not worried about UniCredit either. But there's heterogeneity under Deutsche Bank has had a rocky couple of years. You don't need to name names, but do you think the regulation is enough to deal with all that heterogeneity? And if it's not, bank runs, as you said, can be like a multiple equilibria where maybe the 5,000 euro people don't run, but that's just an average. Some people are larger than that, and they do.
Okay, I think, can I exclude problems? No, I can't. But I think if you look at it, Credit Suisse had plenty of capital when it went down. And the issue was, again, liquidity and trust. And when I started in this business a long time ago, I was told that if every depositor or creditor comes to us their money back in a bank, you're done. There is no bank that can withstand that, which then translate into trust. And trust is earned how are you strongly capitalized? Are you quite liquid? Is your asset quality good? So it's not one factor. It's a series of factors that do. So if you look at the bank run here in the US or Credit Suisse, the day after, our deposits went up, not down, because we're among the organizations that the world outside, the population sees as more reliable or more solid. That's trust. That's a perception. And I happen to be a nice perception, but it is a perception. But if everybody said, no banks is somebody I should trust and start taking the money back. I mean, there is the mother of a client of mine that has literally her cash under the mattress because she does not trust banks. If that is the dynamic, I don't think any regulation can help you, honestly. I don't think. But I do think that if we are talking about, let's say, going all the way into not going into the 1% or less than 1% tail, I do think that the current level of regulation and how things are managed at the moment is quite protected.
In the United States, there's a lot of discussion about how the big money center, but clear business model that's really diversified across a range of activities, investment banking, wealth management, traditional banking, et cetera. The really small banks also do. The East Cambridge Savings Bank is right down the street, and I'm sure it's a perfectly wonderful place. There's worries about the mid-sized banks, and especially worries about they are in deposits for funding in a world where technology might be changing. People might, even maybe at 5,000, but certainly at numbers higher than that, be able to more easily move their money, get higher interest, still have all the liquidity and benefits of a bank, and then absent that funding, what it is they're doing. So people are expecting a certain amount of consolidation in banking here in the United States. Is there any analog to that set of issues in Europe? And also in particular, do you think technology will make deposits less sticky over time? And what do you need to do about that?
So, yes. However, and probably I don't know if to a greater degree than the US or not, what you would call community banks or regional banks, or banks that are very close to certain communities, certain regions, certain geographic areas, and are very connected, tend to have an edge with respect to those customer bases to very large banks that are more disconnected, more distant, where the decision-making process is longer, taken further away. So that business model compensates like that for now. But it is clear that with the increasing investment in technology that you need to make, and that has a scale benefit with a number of other things. Size in banking matters and matters a lot. So I do think that regulators, and they were public with that, and banks are seeking scale. And you will see continuous search for scale even in Europe. If banking union does not happen primarily domestically, if banking union happens cross-border, etc. With respect to technology, true. We have made the mistake, which is a good mistake, so high-class problem to make, that we thought that given the technology that exists today and the greater financial literacy and the greater level of information, the so-called pass-through or beat of deposit, i.e. how your client base will react to a level of return that they can get better somewhere else, will move. And we were wrong. They don't. And
so far
they don't. And everybody tells us so far, and every quarter we have projections that are overly pessimistic, and then they go back. Why is that? Every investor tends to ask me that in Boston as well. And I do think that it also has, because we're looking at the problem sometimes in a different way. So is it true that banks are not paying significantly for current account? Yes, that is true. But current accounts in Italy or in Europe is a means to manage your day-to-day life. I mean, pay your bills, do all of these things. Usually balances, especially in an economic bloc that was negative rates. Usually your balances on current account are low and predicated on this is what I need to manage my monthly outgoings, etc. The excess cash, especially in Italy, but in all of the other European Union countries, have been moved a long time ago because we had 50 basis points negative rates into term deposit, sovereign bonds of the country. In Italy, that's very sensitive, or asset management. So when rates became positive, where we saw outflows more than from current account into time or current account into Italian government bonds or whatever, we saw outflow from asset management that now was no longer competitive with getting 4.5% on an Italian government bond debt tax-free. So we saw outflow from assets under management into assets under custody. And therefore, the question then becomes, when rates come back down, and it says, are they going back up there? But if you think about it, if you have 5, 10,000, 15,000 balance on your current account, your sensitivity to pricing is quite low. You're much more sensitive to fees, which is why we're attacking fees, we're reducing fees. But your sensitivity to pricing is quite low. And so if I were to look at wealth management and private banking, where the balances are 250K, 500K, $1 million, well, there it moves. And it moves a lot. If I look at corporates, small micro company moves little. Large corporates moves a lot. So I do think it's not a one size fits all. It depends on the benefit to the organizational counterpart of.
How much do the small ones move, not based on fees, but based on features? And you have these nifty fintechs that'll make it easier to pay your bills and track your money and manage your life. And sort of a stodgy old bank like you can't be quite as nifty on your website as they
Well,
can.
I think, if you take the rates effect out, obviously fintechs have had quite a significant effect. But, if you look at how many of those actually thrive, especially in Europe, you tend to have a glass ceiling at 300,000, 500,000 clients. It seems that they attract a certain level of client base that likes all the things you said, and then it stops. And I do think it is because to scale it to the next level, you get into either you're a category killer and you're PayPal, and okay, transform the way you do payments. Or if you then start wanting the multitude of services that you get in a bank. So it's not only current account and payments, but it's current account and payment plus mortgages, current account and payment plus investment, etc. Your technology starts having trouble in doing that. We see that also on some of the fintechs. Many banks are trying to experiment with bank in a box, starting from zero, and then they have a view that at some point they'll move the entire bank on that and they'll drop the old system. For the time being, those cannot take the volume, and they cannot take the complexity of having to offer everything that a normal bank can. So I do think there are checks and balances. Certainly, the banks need to invest a lot more in technology and reduce the technology gap and the quality of service gap that they have vis-a-vis some nifty fintech. But on the other side, for them to acquire the clients and give them the entire product range, it's not that simple.
So now let's get to sort of macro and macro adjacent to banking. Europe's grown approximately 0.0% over the last 4 quarters. Congratulations that Italy is ahead of Germany in that regard. But the ECB is raising rates. How much is that cutting back on lending and slowing the economy? Same time, though, headline inflation's come down a lot. But if you look at core inflation over the last 12 months, it's 5%. Measured in the same way, core inflation in the United States is 2% using the European methodology for measuring. So, what's the ECB to do between the slow growth on the one side, the high stubborn inflation on the other, and how are you transmitting their policy?
I'm a big disadvantage to you, but so I think it's. I
don't think there's a good answer to this question.
No,
just to be clear at the outset, because there's a clear answer to China. They should just expand because they have low inflation and low demand.
So I think the complication comes that, in my opinion, the inflation driven in Europe is different to the one that you have here in the US. We have a let's call it supply-led inflation on energies, raw materials, and that we imported from the war. But if you look at our labor market, if you look at our internal demand and everything else, actually we were not at a level that created inflation. So as the ECB fights inflation, in a way, the increases of rates does not affect the price of raw materials and the price of energy. It does affect demand. The problem with that is that if we run this concept to the end, is we're trying to bash the good part of inflation in order to offset the bad part of inflation. And I understand that we need to fight inflation, but at the end of the day, we need to be very careful how we do that. The second thing is the US have taken rate up quite dramatically. We've done the same, but we come from -50. I mean, for the world out there in Europe, going from -50 to 4, it's beyond what people appreciate. Because let's just suppose you had a mortgage of 250K in Italy. At -50, you are paying tens of basis points. All of a sudden, if you are in variable rates, all of a sudden, you multiply that by 5, 6, 8 times. And if you were relying, thank God the Europeans do less, on consumer loans, that's even greater. So now you are a family with a relatively lower income. On the one hand, everything you buy, from foods to gasoline to whatever it is now up dramatically. And on top of it, that's a lot more than current account. Your mortgage and your consumer loans have multiplied to an excess that you're not in budget and you weren't expecting that. That is the issue. And I am actually very surprised that our non-performing loans have not increased already. But the system seems to be holding. So the ECB needs to manage the balance of, I want inflation down, But on the other hand, I know I'm compressing the productive part of my demand, et cetera, et cetera. And as I have taken rates up from negative in a very short period of time, you haven't seen the translation of the monetary policy that they have done in full on their impact, because it's been doing every time so fast. And many people are concerned that you're going to see the deceleration all in one go. That is what they're struggling with. And I would not like to have to manage that problem, but that is the issue. The other issue is more theoretical, you can answer that, is we've always had some sort of a rule of thumb that 2% inflation is the bar in a global economy. If you're fracturing the world in pieces, redoing the value chain, by definition, all this fancy world means your prices and costs are going up because you were optimized from the best provider throughout to you and then the best exporter. Now you can't do that. You're doing that locally, that's higher cost by definition. So as we readjust to the new world of a more fragmented world, is 2% inflation the right level? And we have a tendency of having an answer from all the central banks as absolutely yes. But it is a question worth answering.
So I'm thrilled you asked that question. I've argued for the US to shift to 2 to 3, and people treated me like I was some like deranged, out of touch academic. So to hear somebody that actually knows something about the real world at least be open to that conversation is far ahead of where Christine Lagarde and Jay Powell are, at least publicly, at this moment. I'll also just make one brief comment, which you can reply to, or else deal with the next question on climate change, which is I do think you're right that the inflation in the United States started largely with demand, with supply making it a bit worse, as in contrast to Europe, where it started largely with supply, with demand making it a little bit worse. I do think, though, in Europe, it's been built in more to expectations, more to wages. And so the risk of wage price persistence and self-fulfilling inflation, even absent supply chains, is much higher now than it appeared to me a year and a half ago. So,
and I would just say that you're right, because at the end of the day, we just went through contract renegotiation in Austria, in Germany, in Italy. And obviously, with that scenario that we went through, you cannot expect not to have to reset salaries and remuneration for everybody. So at the moment, for banks, we always forget that we have really good dynamic on your net interest income because of rates, but because of inflation, your cost of labor is going up very significantly. And the challenge that very few people focus on is rates go up, they also come back down. Actually, we all expect them, hopefully, to come back down, 2.5, 2, etc. For as long as I have rates at 4, I don't even look at my cost because my margin is fine. But if I increase the cost because of inflation and rates come back down and my revenue drop, I can't go back to labor and say, oh, now I'm going to take your cost down. So you're going to have a combination of top line compressing at the time where your cost base has just gone up. And that will have a double whammy effect on a lot of us, which is very difficult to solve, because how can you not recognize at least inflation, if not inflation plus, to employees who make, you're talking 35, 40, 45K with inflation levels at 8, 9. It's not possible. It just would not be ethical. It's not possible. So managing these two things is, in my opinion, very complicated.
Great. So I have one last question for you. We have 2 microphones that people can head to ask your questions. And why don't you take whatever subset of this you think is most interesting, which is just climate change, how you're thinking about the risk side, the risk of the damages of climate change, the regulatory risks of companies you might lend to, or the regulatory risk you might come under for the types of loans you're making. And then the flip side, the opportunity and the role that you're going to play in the green transition. So, and I realize that you've probably given whole speeches on this topic.
I'll limit it anyway. But so I think I think you need to start from the right place. First of all, providing a positive contribution to environment and stop talking about it's not possible, not now, somebody else is going to do it, et cetera, is critical. At least us European feels is critical. I feel is critical. I have a 13 years old. I'm not living it like that. So point number one, you need to start from that, because I personally believe that, especially nowadays, the argument that it's a great business opportunity, certainly for bank it isn't. Because if you're lending to brown versus if you're lending to green, your spreads are going to be a lot larger in brown than they're going to be in green. And certainly the volume of brown and the volume of green are not comparable. So if you do a business case, you're never going to do it. But it shouldn't be a business case, in my opinion. It should be a transition over time, your company, your client, and you transform. And in a way, not that I would have a silver lining, if there is one, of this war, is that everybody is accelerating out because we are too dependent from energy and brown from other jurisdictions. So it has put a survival in general, has aligned, and therefore we're going into that direction. How do you do that? Is probably the biggest that you're going to find ever. Environment has become a great tagline and a great headline in every newspaper, and it seems that the best thing to do is to put bars that are higher and higher and higher, sooner and sooner and sooner, but people don't do the numbers on those. And the reason that some of those bars are, if you ask any scientist, they will tell you they're not achievable. So we moved from finding a lot of excuses for not wanting to do it to all committing to things, knowing that as of today, we don't know how to get there. And I think that's very, very dangerous. So in our opinion, number one, it is a must, and that needs to be how we view the business at the origin. Number two, it needs to be uncertain in reality. And the reality is not the same everywhere. Meaning, and I use that example a lot, we are the number one bank in Bosnia. In industry, coal. Not exactly the richest country on the face of the earth. You can't flip the switch like that. If I were in Denmark, I could. I can't do it there. So then the concept becomes not one size fits all. It becomes, how do I use my position to accelerate the transition in a way that brings society along and gets us there faster than if I had not done anything? But flipping this, so because people would tell you there are three options. Option one, I stay there and I flip the switch, I don't finance it. Yeah, but in some cases, you're going to bring an economy to rest. And by the way, then the whole society in that country will go in exactly the opposite direction because they need to live. Option number two, you sell it. If you sell it, by definition, you're going to sell it to someone who doesn't care, because otherwise they wouldn't be buying it. Or three, in my opinion, we do what we do, which is to say, let's challenge ourselves. How much positive pressure can we make to accelerate the transition? And let's make it, by recognizing that it's very easy for me from my sofa to say, all of this you're going to do, but there are some people that without work cannot get there. And I do think that those are moral issues and they're not very easy to manage. But for us, we look at it like that. Then there is the most, let's call it political, get into that as to whether central banks should engage in climate risk, etc., or if that is more of a political arena. The only thing that I would say is that I would take it in a different way. If they engage, it should be consistent with the rule of law of the governments of the countries where we all are. Meaning, there cannot be a bar by a regulator of banks that is higher than what, I don't know, the German, the Italian, the French governments say you can do, because it puts us in a position to be a gatekeeper at a lower level of capacity than what the local government has taken a decision on. And that is very, very difficult to manage, because the company on the other side is just going to tell me, but I'm sorry, but this is absolutely, I'm within my tolerance, I'm within my thing. My transition, as I'm supposed to, who are you to tell me otherwise? So that is the difficulty. The other difficulty, and I'll leave you with that, is that, banks have this role that is never clear, private sector, public sector, arm of public policy, not arm of public policy. So in theory, as a bank that finances and therefore gives credit, I would need to gather all the information about environmental issue on all my clients across their value chain. Know your client has limits, okay? Because if I need to know what the client I lend and then the value chain below it does, and see if that fulfill environmental limits and risk, that is a massive thing to ask the banks to do. And it's very difficult. And by the way, there is a simple answer that some of the clients are saying, none of your business, because my government is not asking me for that. Why are you asking me for that? Et cetera, et cetera. So principle, we need to get there. And I think we need to get there faster than people say. I think we need to spend the time to understand what that means and to actually commit to things that are feasible rather than all claim that we have this fantastic target that we have committed onto. And a large part of your organization says, you know what, maybe you're not doing it thinking about it, but you're never going to get there. And that's wrong, because then you get into greenwashing and a number of other things.
Great, thank you. So we're going to take 2 questions and then you can answer either or both. Oh, and you have a question.
Does it work? Yeah.
Yeah, and just introduce yourself and ask your question.
Hi, Kieran Blomberg, MPA student here, previously with the Ministry of Finance in Germany, working on banking regulation. And you mentioned a lot of the kind of regulatory hurdles of ring fencing of capital and liquidity and so on, and the lack of a deposit guarantee scheme. My question would be, how likely do you think it will be that we will really get towards a more integrated banking union? In some ways, previous crises such as COVID showed us the value of having a strong banking sector. I mean, in many countries in Europe, in Portugal and so on, the banking sector was huge in kind of giving private moratoria, and the governments relied on banks to take the hit. And so in some ways, having the strong banking sector is massively valuable, and has become more valuable from a supervisor's and also like a government's perspective. So how likely is it that we will see more progress there?
I need to wait for a second.
One more question. Oh,
I just have a really quick question. My name is Jack. I'm at the college. I was interested in your perspective on the rise of the far right in Europe and the potential challenges it might bring towards unionization and kind of creating synergies between different nations in the EU.
The challenges of, sorry?
the far right.
The far right.
All right. Okay. So
that wasn't strictly a question.
So let me put it this way. Any CEO needs to be an optimist. So I am optimistic about banking union. If I look at experience, I shouldn't be. But I do think that, as you raised, Europe has gone through negative or zero growth for a long, long time. In that environment, banks are fueling very little. If we want to grow, there is no other way. There isn't. It just isn't. So that's the first point. The second point is that, maybe not as CEO of UniCredit, but when I used to have this conversation with ministries of 5 years ago, talking about banking unions, I wouldn't go very far. Today, we do realize that policies without financial propellant or without support from the banks are going to go they're not going to go very far. So now the debate is more, how can we do that without endangering our country? But the debate is there. Last time I was with a couple of high-ranking Ministry of Finance in Europe, which will remain nameless. They said something that nobody has asked me for a long, long time. come up with a plan. Don't wait up for us to tell you the plan, come up with a plan. That's the other issue, because we need to take our own responsibility. Maybe because of the reputation and what banks have gone through in the last 10 years, especially in Europe, banks have almost always kind of not taken a proactive view on, oh, come on, we need to do this because it has this impact, because it was always seen on, no, I better not engage. Banks need to engage and need to highlight what it is that can be done to make things easier. And I do think that the time is more mature now than it was in the past. Far right and integration, etc. Look, again, personal views, extremes don't work, in my view. But I think we need to look at why we get this. And we get this because effectively our population is unhappy. And why are they unhappy? I would like to simplify. They're unhappy because there hasn't been enough growth, enough wealth creation, enough redistribution of wealth, et cetera, et cetera, et cetera. We all know what it is. So the best way to eliminate that is to address those things. And to address those things, we go back to union, because, I mean, look, if you look at the growth of Europe from 57 to the 80s because of the Treaty of Rome is extraordinary. And then we decided to stop. But if we were to converge, to decide to go to the next phase and converge, we would be surprised at how much opportunity and wealth creation and these kind of things. And, you know, current extremes usually work this way. I am going to grab this much from this part of the population to give it to you. But at the end of the day, the pie is what it is, and it's declining. And at the end of the day, one after the other fall on their face because there is no creation in there. And I do think that the only way is for Europe to get more convergence than we have now.
Okay, last question.
Many thanks for that. I am fortunate I'm one of those guys that actually designed the capital markets and the banking union. We thought that they actually asked.
Oh, and your name? Oh.
Lucio Vinhos de Souza, former advisor to the President of the European Commission. I have been partially preempted, but my real question is the following. We have been through 3 or 4 different interactions of some of the CMU and BU legislation. So what shall we do? What's the plan if we go and ask you again what we should be doing? What shall we be doing to try to unblock this?
Well, I mean, I think banking union is probably easier than capital market. And I'll tell you why capital market is more difficult, because to do capital markets, you also need to create institutional investor and a pension system. So fundamentally, you would need to, because otherwise there is no feed there. But I don't look, I mean, at the end of the day, the legislation is there, but as you know, there are a lot of exceptions in the legislation. So most of Europe gets liquidity to flow through its market. So between Austria and Italy, there is no problem. Between Germany and Austria, Germany and Italy, there is, because they use an exception. You know, so I do think a lot of the legislation is there, but then there has always been an implementation issue, because more Asian markets makes you not do certain things, or because the regulation, in order to achieve agreement by everybody, has left some, shall we call them loopholes or exception in there to block it. Derogation. But if I asked you what are the 3 or 4 things that you think are critical to be done, you would have the same answers as me, no? So on deposits, we have an issue on sovereign. So there is at the end of the day, it goes with 2 main issues. One is ego, and it is, I am a country XYZ, this is my bank. And banks are very sensitive, if you take that. But I could do the same thing with airlines, frankly. The second one is substantive. I don't want to end up, given that we don't have full convergence of the EU yet, of the problems of a bank in another market, because it took my deposits, or it did this, or it did that, and it creates a liability for me. So My view is very simply that we need to look at what is the regulation necessary to make sure that that does not happen. And then to a large extent, so let me show you this way. So let's suppose that tomorrow I wanted to take, I have 13 market. I wanted to take a bank in market B, without names, and make it a branch of bank in market A. You know what is the best way not to make it happen? Deposit insurance scheme. Because for those of you who don't know, the deposit guarantee scheme is not portable. So if I have a bank in Germany and it becomes a branch of Austria, not going to happen. But anyway, if that was the case, by becoming a branch, I lose the entire contribution to deposit guarantee scheme, and I need to replicate it once more in Austria because protect just so massive that it's impossible. But at the end of the day, in theory, I can do a branch. In practice, I cannot if I own something that has contributed. So can the scheme be portable? Or do you trust that? Do we do a European-wide scheme? Or, but this is the issue, because until we resolve that, you're blocked in doing the rest. So I do think that the regulation is not the problem, because we all know what we need. What the problem is that those derogations have made it impossible for us to bring it to the last level.
Great. Well, no. Join me in thanking Andrea Orcel.
Thank you very much.